The steps you should take to secure the right buy-to-let mortgage for you. In recent weeks, we've been attending the excellent NRLA On Tour events, which have featured a great range of topical and relevant information for landlords. Now, at these events, we have presented our own buy-to-let market update, helping property investors to stay ahead of the game and make sure they are best placed to get the most value from their investments. Building on articles I've written and videos I've done, where we've talked about being document ready, we thought it would be useful to provide some more helpful guidelines. Depending on your circumstances, some of these may or may not be relevant specifically to you, but it's worth taking a moment to consider different scenarios so that you can be well prepared. There are two main scenarios to consider. The first is if you have a buy-to-let mortgage product that is due to expire in the next 6 to 12 months. The second is if the soonest expiration of a buy-to-let mortgage you hold is longer than 12 months away. In both scenarios, the most important message is not to rest on your laurels. It seems as though we are reaching the top of the cycle of the Bank of England base rate increases, but it's important to remember that fixed rate mortgages are not priced on bank base rate. However, it is indeed swap rates. Swap rates essentially indicate the rate at which financial institutions lend money to each other, taking into consideration both the current base rate and expectations for future interest rate movements. They have a more direct impact on the cost of funds for mortgage lenders and, as such, are of greater relevance to the pricing of your fixed rate buy-to-let mortgages. The thing to remember about swap rates is that while base rate may move up and down in a fairly linear way, with decisions made by the Monetary Policy Committee on a regular basis, swap rates are determined by market movements and can change daily, moving up and down frequently. So even if base rate is steady or even falling, swap rates can oscillate. As soon as your current buy-to-let mortgage product is 6 months before expiration, you should be ready to move. So speak with your broker early to research the market and ask them to secure the best rate that is available to you, be that a product transfer or a remortgage to a new lender. Some lenders will allow you to switch mortgage products up to 2 weeks before completion, and although some may charge for this, others may not allow it, so you need to check it with your broker. If you are able to switch mortgage deal further down the line, securing a rate now acts as an insurance policy should rates change in the coming months, especially if the market becomes spooked again and swap rates rise. As you approach the expiration of your current mortgage, your broker can then revisit the market to see whether you would benefit from switching to another rate available at the time or would be better off sticking with the deal they've just secured for you. We are seeing quite a lot of product innovation in the buy-to-let mortgage market at the moment. Many lenders are introducing larger product fees to reduce the stress rate. We've also seen the introduction of 5-year fixed rate with 3-year early repayment charge products, or even lower ERCs in the first year, for instance. There's a lot of choice, and it's important to consider your product selection carefully. And remember, a lender decision in principle doesn't necessarily secure the product. For those landlords whose earliest buy-to-let mortgage expiration is longer than 12 months away, there are still things that you can be doing to ensure you are prepared. First, check that you are charging the current market rent achievable on that property. Increasing the rental income earned on the property will make it easier to secure a mortgage on it in the future. Also, think about the EPC rates of the property. While proposals for a minimum EPC of C on rental properties have been withdrawn, there are lenders that will reward those properties with EPC ratings between A and C. So check with your broker to see whether you could benefit from what comes with when looking for a new mortgage. At the very least, you should be documenting the EPC rating and mortgage expiry dates on all of your investment properties. Pop a diary reminder in to speak to your broker 6 months before the end of that EPC. And don't forget to be document ready. By taking these steps, you'll give yourself the strongest possible chance of securing a mortgage with the best rate for your circumstances and give yourself options should the market retract again in the future. It's also highly recommended to seek legal advice and stay up to date with changes in the UK landlord and tenant law. You could consider joining a landlord association such as the NRLA to help you stay compliant, save time and stress, save money, and ultimately help see your rental business thrive. This information, of course, is a general overview. It's not exhaustive, so be sure to conduct further research or consult legal professionals for specific guidance based on your situation, location, and circumstances.